The bond market to me is broken. It is now a function of illiquidity because nobody's involved in the market and there's only sellers. And I think it's going to cause some tremendous problems.
Hello everyone and welcome to the Daily Crypto. We are back with yet another video featuring Raoul Pal, so make sure to stick around till the end. But before we get started with the interview, let's take a look at the Fear and Greed Index for today. As of recording this video, it is at 22, same as yesterday. Currently, Bitcoin and Ethereum are trading for 19,370 and 1,315 respectively. With that out of the way, let's get right into the video.
What role does gold play in the investment landscape? You see, there was a narrative from the 1970s that has been held on to, particularly by boomer types, which is that you see one day this financial profligacy will create a bull market in gold again. When you look at gold mining stocks since the 80s, they've actually not gone anywhere. When you look at gold, it has risen, but it's not risen with inflation. In fact, in real terms, gold's gone nowhere. In fact, it's probably down. The reality is gold does a certain thing and it does it really well. Gold works really well when you debase a currency. Remember in the old days, they used to debase gold by clipping the corners off the edge of coins. They don't do that now. What they do is devalue your fiat currency. When you look at a chart, and I've got a global macro investor chart of gold over the last 20 years versus a basket of 27 of the largest currencies in the world, excluding the dollar, gold just kind of ratchets higher, and it ratchets higher every time there's a devaluation of other currencies.
Raoul says that gold is slowly becoming outdated because if we look at gold mining stocks, they haven't really moved since the 80s, whereas the price of gold is considerably higher. However, if we take inflation into account, gold has remained stagnant, if not losing some of its value, over this period. The only time it has performed really well was when currencies got debased.
So gold right now, when you've got positive real rates, and they're going up a lot because the bond market's decoupled from everything else, what you've got is a bad environment for gold. The moment the real rates go negative again, that's destroying your future wealth. Gold does pretty well. Now, I don't think gold is the best investment to capture this tail risk. I actually think crypto is much better at doing it. I actually think technology stocks are probably better at doing it. But gold is less volatile, so risk adjusted, it's just fine. Right now, it's just not a good bet. And even though not that many people own it these days, it's not a retail investment vehicle. Sure, in India it is, but even in India, we're seeing the rise of crypto. Actually, the point about India is actually quite interesting, is if you look at gold in terms of rupees, if you look at rupee itself, it's devalued over time. So dollar rupee has been doing that. Then after you adjust it for gold, i.e. Indians buying gold, they've actually outperformed the rupee perfectly. They've maintained their purchasing power over an extended period of time. So it works very well for stuff like that. Works very well for emerging markets and really good for debasement. It's probably not the vehicle if you want to create wealth. It's a vehicle to protect wealth over time.
Raoul believes now is not the perfect time to bet big on gold. However, it does have some advantages like reduced volatility and liquidity. But it is not the ideal instrument for retail investors given there are much better options available like crypto.
The dollar is in this doom loop where it's a game of musical chairs. The musical chairs here are the US is 25% of world GDP. 87% of world trade is in US dollars. Most international borrowings are in dollars. The eurodollar market is the epicenter of that. The issue is when the Federal Reserve start taking money out of, or liquidity out of the system, it knocks through to this murky world of eurodollars and foreign dollar borrowings. And those weaker borrowers start scrambling for the dollars. And it's a game of musical chairs where somebody gets rug pulled and somebody falls to the floor because there's not enough chairs to go around, not enough dollars. That was Sri Lanka. That started this off, and I tipped you guys all off about it back in March, I think it was. Then after that, we've seen numerous countries go into default or renegotiate with the IMF and the World Bank and others. That's the shortage of dollars. The shortage of dollars is what puts the European banking system under pressure. The shortage of dollars kind of knocks through for the global market. Now, there's another issue going on right now is the US, its trade deficit. If you think of a trade deficit, it's the US buying goods abroad. That's spending dollars elsewhere, so the rest of the world gets those dollars and they get to recycle them into treasury bonds or do other stuff with them, have borrowings against them. When the US runs a smaller deficit, there's less dollars in the global system. So that makes another problem. So you've got liquidity being sucked out, and you've got the trade deficit, meaning less dollars are going in the system. Yet in a slowing economy, everyone needs to pay the interest on their debts, so demand rises.
The US dollar is running into liquidity issues as there is a shortage of dollars in the global monetary supply due to the US trade deficit. The only reason why we are seeing it grow in strength is that it is in demand. As soon as it decreases, we will see the US dollar drop fast.
That becomes an issue, or they want to receive the dollars to pay off the interest on their debts. That becomes an issue because it's driving higher interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this before. You see, the issue is traditionally the buyers for foreign central banks, they're out of the market. The Federal Reserve with quantitative easing, they're out of the market. The banks, the biggest buyer of all. Regulatory purposes meant that they can't do it. So cash is piling up in the reserve repo market. So there's trillions sitting in there with nowhere to go, not being put into the system. And the pension system. And the pension system has just taken the biggest loss ever in the 60-40 portfolio. That's the portfolio of equities and bonds, 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. This is unprecedented. I know everybody looks at the equity market and says, well, the equity market's only down 30% if it's the NASDAQ or 20% if it's the S&P. They're missing the fact that pension portfolio has been obliterated. So if you think what just happened in the UK, there was some leverage to cover their liabilities. And with this drawdown, they blew up the pension system, and the Bank of England had to come and step in.
All these factors are contributing to the hike in interest rates, and we have reached a point where there is no one willing to buy bonds at these rates. Raoul says this is quite bizarre, and it goes to show how bad of a situation we are currently in.
So I think the path of pain is to go lower, suck more people into short, and then rip higher. And it would rip higher because bond yields start to fall as they start finally recoupling for the business cycle. Bond yields have massively decoupled from the ISM survey. That's a relationship that's gone back 50, 60 years, including the last inflation episode. It's decoupled from inflation break-evens. It's decoupled from economic growth by any measure. The bond market, to me, is broken. It is now a function of illiquidity because nobody's involved in the market and there's only sellers. And I think it's going to cause some tremendous problems. And that eventually is going to create the answer. And the answer to everything is always more cowbell. The UK showed it, more cowbell, print more money, get us out of this problem. When people say they'll keep hiking until it breaks, well, when it breaks, more cowbell. You know, it's all, the whole system is now set up for one cry, which is more cowbell, turn the taps back on. It's a sad state of affairs, but that's how it is. But you can trade that to your advantage. Trading it to your advantage is understanding when that shift comes and what it does for risk assets. It's very attractive.
The bond market has completely decoupled from all other instruments. Raoul says it is crucial that it gets coupled again because otherwise it will lead to the fall of one of the biggest financial market products, which are the treasury bonds. There is no turning back now, as the only solution the Fed and other governments have is to print more money, which will pose the risk of a full-out financial crisis.
The forces at play in the oil market are reduced supply and reduced demand. I said that demand would overwhelm the supply issues, and that's been true. Oil price has been coming off from 120, got down to 70 something last week. Rebounded. Why? Because the Saudis like, no, fuck you, we're going to put up the price of oil again. And Biden's like, no, we're going to sell our oil from our SPR. So we've got this fight going on, this geopolitical fight about what is the fair value price of oil. Obviously, the markets aren't allowed to set oil. If you think the interest rate markets are crooked by the central banks, meet OPEC. So we've got that going on. The question is going to be, okay, if we get a recovery now, what happens to the price of oil? Well, if economic growth comes back now, well, then oil is going higher. If I'm right and economic growth continues lower for the next 6 months or so, and sharply lower, then we'll have eroded enough demand in oil that it won't come back as fast. Now, what really matters for inflation is the rate of change of oil. Does it get back over $120? I don't think so. It's possible. But if it does it has to do it slower. If it does it slower, then the rate of change of inflation won't come anywhere near here. We will see inflation in the next cycle. We see inflation every cycle. But my bet is it is not as sticky and as high as people expect. People have this 1970s narrative because that's all they know. Generally speaking, I don't think that's going to be the case because we're missing baby boomer demand in the global equation. So you're trying to create a supply-driven inflation shock that lasts, and that generally doesn't tend to last.
With the Saudi government basically telling the US that they are going to be increasing prices of oil, Raoul thinks a $120 oil is not too far out of the equation. However, if he is correct about the slowed economy, it will continue to drop lower for at least the next 6 months. Thank you for watching this video. Hit the like button and subscribe to our channel so you stay updated with the latest market news and events. See you guys in the next video.